also be very crucial, and traders are watching out for that. But to understand this in greater detail, we now have guests joining us on the show, Mr. Anindya Banerjee, Head Commodity and Currency at Kotak Securities, and Peter Mcguire, CEO, AustraliaTrading.com. Gentlemen, thank you so much for taking your time out and joining us this afternoon on ET Now. And Peter, coming to you first, what do you make of the OPEC Plus release that came in yesterday, where they are expecting a supply glut? Was that largely on expected lines given the pace of OPEC Plus supply increase that they have announced over the last few months?
Well, good afternoon, Ashish. I think a couple of things that really took the market by surprise was a fairly extensive sell-off in the sense of 4%, as you highlighted. And that was a real wake-up call because I think all of the shorts, all of the longs were squeezed. There's no doubt that the shorts really drove that market after hearing that sort of announcement. And it's going to be interesting where we roll into Christmas. So the IEA is going to release a report today. You've also got I think the overall momentum is to the downside, and the market is very mindful as far as a glut and how that's being interpreted to the market. And this is going to be quite fascinating how it rolls into Q1 of 2026.
Okay, market is mindful that perhaps we are expecting some glut in the global market. But if you could give a number to the Brent crude target going forward from $62 per barrel, where do you see Brent crude headed going forward?
I think it's going to be around, I want to see it take out 60 to the downside. I feel as though once it gets through that sort of number, then it'll be a continual softness over the rest of Q1 for 2026. And it may even get under 60 by the year end. So that seems to be the general consensus that the energy people that I talk to, the overall side of it is WTI probably that $56 to $55 mark. Let's get Brent under $60 and then we'll take another gasp as far as where we see value to short the market even further.
Brent at $60 by the end of this year, WTI at about $56, $57 per barrel. Anindya, coming to you then, would you concur with this estimate? What are you making of the recent release, and what will your target price be then?
Yeah, Namaskar, and thank you for having me. I completely concur. In fact, what has happened over the last 3 years is that the oil market has gone from being a producer market to now a consumer market, and that is likely to stay over the next few years, which means the kind of surplus we are talking about, which basically means the OPEC is based on losing control of the market. Because even if OPEC is able to maintain the supplies, which means if they don't increase supplies over the next, let's say, 1 year, the non-OPEC supply will be so much that it will be able to more than meet the jump in the global demand for oil over the next 12 to 18 months. So that is a precarious situation for OPEC, because on one hand, if they cut supplies, they lose market share. But there is no guarantee that the OPEC cuts would be able to push prices higher. In the short term, winter is generally a time when oil prices see a lot of support, and especially with the product market, the crack spreads and the GRMs are looking fine. So if over that period of time, we might see a slow decline towards the $58 mark, say by December on Brent. But once 58 breaks next year, the next support comes in around $50. That's a big fall. Interim, we might see a few geopolitical-led price spikes. If US does some operation in Venezuela, we could see a spike. Or Israel does something in Iran, yes, it can spike. But those spikes won't be sustainable because they won't be able to create much of a supply shock. And if the Ukraine and Russia thing resolves next year, that creates an even bigger supply overhang.
Okay, so that's as far as demand-supply dynamics is concerned. But OPEC Plus, last time when they met, they decided that they will be increasing output for December. But then they will pause their production hike in the January to March period. One, on account of seasonal weakness, and second, also because they are expected to review Russia's sanctions. Peter, what do you make of this OPEC Plus recent announcement? And do you expect them to revise their guidance for January to March period basis the developments that happen now?
Well, they could well do. I mean, we've got to get to, and my fellow guest said, there is so many different moving parts to this. There are, of course, the geopolitical, where you could see a little bit of volatility between now and Christmas, which would not be unusual considering what we've seen for the first part of 25. Oh, for the earlier part of 25, and then rolling into the first quarter. Yes, OPEC will have to take a deep breath on this. We all can't discount either how the US is going to ramp up their production. So this is going to really cause, I think, that will only exacerbate the extra oil on the market as far as the volume, and that in turn I think is going to cause significant downside risk for producers if they're trying to get that $60 to $70 a barrel price. And you've had geopolitics stripped out, you've had oversupply as far as crude, then naturally it's going to be softer prices. And yes, it may well get to 50. I want to see Brent at that 58, 57 sort of handle, and then be able to evaluate where we are from the next couple of months leading down.
Understood. So that's as far as OPEC Plus decision is concerned, and Peter is saying that perhaps they could go ahead and change their guidance depending on the kind of developments that we see over the next few days. But Anindya, what do you make of the current supply situation in the global market, and for India in particular, what does that mean? There were some sanctions on on Russian exporters, because of which we could not import, and there were several news pieces surrounding that. What do you make of its impact on the Indian economy?
Right. So if you look at the data of the Russian exports of oil for the first week or so of November, it is basically showing a decline of around 2.5 lakh barrels. Roughly 1.9 lakh barrels is because of the Indian oil demand coming down from, or the Indian oil imports coming down from Russia. But see, even a 2.5 lakh barrels or a 3 lakh barrels is not going to have a big dent on the demand supply balance, because the market is well supplied and basically being supported by these expectation of some kind of a geopolitical flash, right? So that's not a good way for the bulls to defend a price. So as far as the Indian economy is concerned, it's good news, because lower oil prices is like a tax cut for the consumers, because ultimately it's a consumer-driven economy, and a consumer-driven economy, and also the Indian corporates would also rejoice lower oil prices, and that's happening at a time when the GRMs are at multi-year highs. So basically, even the oil marketing companies are enjoying the fruits.
Understood. So GRMs are at multi-year highs, and lower crude oil prices definitely is a positive for Indian economy, given that India imports nearly 80 to 85% of its crude oil requirements from the world. But Peter did give us a target of $57 per barrel as far as Brent is concerned. But on the upside, do you see any kind of risk, anything that could take crude oil prices higher instead of lower?
Well, this is what I was, yes, Ashisha, certainly. And that's what I was alluding to when I said the first part of the first 10 months of the year. We've seen war premiums build in. We've seen geopolitics always at a premium of, $4, $5, $6 a barrel. So we always have that uncertainty. That can be weather outages, that can be geopolitics, that can be disruptions. Everyone understands the dynamics of the crude oil market is one that is difficult to forecast, because you've got all of these other inputs that can very much change market direction within a heartbeat. And so the uncertainty is there, but the overall theme, one would think, is going to be, yes, you might hit a 65 at some point in time, and you can't discount it. But I think the overall view of the market is one of softer pricing, and I think that will remain very much the status quo into 2026. So I'm expecting softer prices from now till the end of 2026.
So expecting softer prices from now to the end of 2026. That's the word coming in from Peter. But Anindya, one last question, and we were talking about inventory. If you can take us through your thoughts on where oil prices are headed on the upside, if at all geopolitical tensions were to escalate going forward, what will your target be then?
See, if you take the most, I would say the biggest price rise which we had seen due to the geopolitics was in the last 1 year was the Iran and the Israel conflict. I think it had spiked like 10-11% in a couple of sessions and it completely retraced it, right? So yeah, take that as a marker. Let's take 58 as the base. Something happens with Venezuela or Iran. You could see a 65 completely conquer that a 65-66 can happen. But will it be able to sustain? Very difficult because the producers are also looking at the same statistics and they are going to take benefit of these kind of spikes and hedge. So yes, spikes can happen, but the trajectory is downward. And once 58 breaks, with the kind of inventory that is building up both onshore and offshore, it will be hard to sustain the 58 for long. And once that breaks, $50 could come in next year. It can go even lower if the US recession risk increases because that will be a demand shock.
Understood. So the trajectory continues to remain on the downward side. That's the word coming in from both our guests. But Peter, OPEC Plus usually comes out with its commentary. And what kind of commentary do you expect from OPEC Plus in its meeting when they meet next? I understand they've already given their outlook for January to March period. But anything specifically that you are looking out for from OPEC Plus this time?
Well, yes, a couple of things. First off, naturally, what's happening as far as the biggest consumer being the United States, what the storyline is there. From a Fed positioning, what's happening, we've just got news in the last matter of hours that the government shutdown is now finished and they're back to work. And so that moves forward. So that's a positive tone. And if something was to have any form of disruption to equity markets, were we going to see no rate cuts or are we going to see continued rate cuts by the Fed in December? Those factors are very, very important. What's happening from an unemployment number? What's the overall theme of the US market? We've been without a number of key data points over the last few months because it's the longest shutdown in history. I'm referring to naturally non-farm payrolls and what's happening on the employment market. So I think that's what OPEC will want to see. The return is how are there any cracks in naturally the US? Are there cracks in global equity markets? And that is, I think, their viewpoint has got to be very much focused on global macro and are there any surprises coming before Christmas?
All right, so that's the outlook coming in with respect to oil prices and several factors to watch out for when OPEC Plus meets next. But Peter and Anindya, thank you so much for taking your time out and joining us today on ET Now and helping us understand what your outlook is when it comes to the oil market.